Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing FSLY stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.9 billion market cap. They're trading at $14 a share, and they have 134 million shares outstanding. FSLY is a cloud computing service provider. It is designed to help developers extend their core cloud infrastructure to the edge of the network, closer to users. In 2022, Todd Nightingale, who had previously worked at Cisco, took over as CEO. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They are a tough company to value since they have negative free cash flow every year. It is smallest in 2023 at negative 32 million, but not that much different from 2020. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every single year. Since they're posting all negatives, we have to look at revenue to see their growth. And that looks decent. Their revenue grows from 291 million to 506 million, about a 20% annual growth each year. That's the kind of growth for a company that's getting close to maturity. You like to see a bit more with a company with such small revenue. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 2.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.9 billion. We divide that by 134 million shares. And we get a calculated stock price of $14. They're trading at $14, so they're trading at a 2% discount. It's a really small buy according to the model. So a lot of this is guesswork since they have negative free cash flow and negative net income each year. I'm assuming they're going to continue a similar growth into 2027, and I also assumed they would convert 20% of their revenue into free cash flow in these 2 years, which is a little more than the average in the industry. There are 243 companies in the same industry as FSLY, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 32 million in CapEx, which is the average, higher than the median. Their debt to equity is a little worse than the median, 0.4. That means for every dollar of equity, they have 40 cents of debt. Software companies usually don't have much debt. The average is above 1, but you can see of the top 20 companies, very few are above 1. Zoom has no debt. They don't pay a dividend because they're still generating negative free cash flow. They rank 86th in market cap of the 243 companies, a lot lower than the average. They're trading at 2 times book value, which means their market cap is twice the equity on their balance sheet. They're trading at 3.7 times revenue. That means their market cap is 3.7 times their annual revenue, or their stock price is 3.7 times their revenue per share. Their 5-year annual revenue growth rate looks good at 28%. Datadog is the highest at 61%. Salesforce is still growing a lot at 22%. They're the largest company in this industry. Here's a list of the top 10 CDN providers, content delivery network providers. Cloudflare is number 1, then AWS, Amazon Web Services. Akamai, they've been doing CDN for I think longer than anybody else. They're number 3. FSLY is number 5. It seems like each year there's more and more demand for quicker content because you don't want to sit on a page and wait 10-15 seconds for your video to load. You want it to load right away so you can watch it. And that's really the big drain, videos. That takes a long time to load and watch without interruption because you don't want to watch a video and then it pauses in the middle so it can load. You just want to watch it cleanly, like pretty much any YouTube video. But if you have your own website, you may not have millions of dollars to spend on a CDN provider. So that's why these companies are so important, because they're always being pushed to the edge to get content to load quicker. You can see Microsoft Azure is on this list, as well as Verizon. Amazon Web Services has the most enterprises, the big companies. Cloudflare has the most SMBs, small and medium-sized businesses. That's this red line. FSLY is doing okay. They're still a small company in this space. but they're up there in the middle of the top 10. Here's how much money companies pay to CDNs. Most pay under $1,000, especially small and medium-sized businesses. But there's some companies that spend over $500,000, well over $1 million, sometimes over $10 million. Could you imagine how much money YouTube pays for all its videos to run smoothly, like this one? Let's take a look at the company's 10K. This is their income statement, 2021, 2022, and 2023. Revenue goes up a little each year from $350 million to $500 million. Let's see if they give a breakdown of the revenue. Here's a breakdown by country. $370 million in the US, that grows each year. $73 million in APAC, that seems to be growing more than the US revenue, at least on a percentage basis. Europe is growing a little bit from $35 million to $42 million, and the rest of the world is pretty much flat. Every year about 19 or 20 million. Of the $500 million of revenue, $458 million is enterprise, the big customers. $47 million from SMB, small and medium-sized businesses. They define enterprise customers who have quarterly revenue above $100,000. Let's go back to the income statement. Cost of revenue, $239 million. So their margins are above 50%. Because if their margins were 50%, their gross profit would be $250 million. It's $266 million. With software or tech companies, generally you want to see margins north of 70%. But that takes time. You have to grow and scale to get there. But they're on their way. They define cost of revenue in case you were curious. These are the fees paid to network providers for bandwidth and to third-party network data centers for housing servers, aka co-location costs. And of course, we all know cost of revenue includes employee costs, and those employees work on network operations, the build out and support and service delivery, network storage costs, cost of managed services, and SaaS, depreciation of network equipment used to deliver services, and amortization of network-related internal use software. Let's go back to the income statement. Below gross profit is the operating expenses, R&D $150 million. They define R&D as primarily payroll and related personnel costs for the design, development, testing, and enhancement of the company's edge cloud platform. R&D expenses also include cloud infrastructure fees for development and testing. The expenses for the company's edge cloud platform, those are expensed as incurred. They're not depreciated and carried on the balance sheet. It's mentioned right here, excluding expenses that are capitalized of internal use software. Below that is sales and marketing, $192 million. Sales and marketing is primary personnel costs, including commissions for sales employees, salaries, benefits, bonuses, and SBC, stock-based compensation. It also includes expenses for advertising, marketing, brand awareness activities, bandwidth, and co-location costs for free trial users. Costs related to our customer conferences, professional service fees, amortization of intangible assets, and general overhead expenses. Then below sales and marketing is G&A, $116 million. G&A is personnel costs, including salaries, benefits, bonuses, and SBC for our admin support personnel. It also includes costs related to legal and other professional services, SaaS costs. Then below G&A is an impairment for $4.3 million. Let's see what that is. Our impairment expense relates to write-off of excess computer and networking equipment, including software that we do not expect to use. So if they acquired a physical asset or maybe an intangible asset like software, and they're writing down the value on their balance sheet, they have to pass through a loss onto their income statement, an impairment loss. Their operating expenses are $460 million, a lot higher than their gross profit. So they have a loss on operations every year. It's around $200 million this year, $246 million last year. They did have a gain on the extinguishment of debt, $52 million. They talk about it right here. Our gain on the extinguishment of debt relates to the partial repurchases of our outstanding senior convertible notes in May 2022, May 2023, November 2023, and December 2023. So it looks like they repurchased some of that debt. It might have had a high interest rate, so they passed through a gain. Then you have interest income of $18 million. This is the interest they earn on their investments. Interest income was $18 million compared to $7 million in December 2022, an increase of $11 million or 158%. And this was due to higher interest rates, the interest they earn on their cash and their investments. Then you have interest expense, the interest they pay in their debt, $4 million. So their net loss is $133 million. A loss per share of 103, that's better than prior years. They are adding shares each year. 116 million in 2021, 122 million, now it's 129 million. When a company loses money, they have to add shares or add debt. That's the only way for them to pay their bills. Let's look at the balance sheet. Current assets of 460 million, current liabilities of 148 million. So they have a pretty good current ratio, above a 3. They have lots of cash and marketable securities, 315 million. This is their statement of cash flows. They actually had positive operating cash flow in 2023. That's a really big deal. It was negative in prior years. So they may not need to add more shares in the future. Of course, they have capital expenditures. Let's go back to the balance sheet. Their biggest asset is goodwill. Goodwill is the premium you pay when you acquire another company. Here's a list of some of their acquisitions. Glitch in 2022, Fanout in 2022, Tessuto in 2020. They paid $775 million for Signal Sciences in 2020, and Domainer, that was last year. I'm not too familiar with any of these companies, but you have to just trust the company you're investing in that they make an acquisition for the right reason, to grow and scale the company and become more profitable. Here's a little more information on Signal Sciences. They were founded in 2014, so 10 years ago. They received $62 million of funding, 140 employees. They provide a cloud-based WAF, web application firewall, and RASP platform, runtime application self-protection. And they focus on website security, which of course you know is a very important thing to focus on. Because if a company gets hacked and somebody steals their credit card information, they may lose a lot of customers. Their clients include Datadog, that's a big company, Betterment, WeWork. I know CrowdStrike is really big in cybersecurity. Let's go back to the balance sheet. Total assets 1.5 billion, down from 1.9 billion. That's interesting. Their cash is down quite a bit. That's probably due to an acquisition. They have 540 million of liabilities. Last year, 940 million. Maybe that's where the $100 million of cash went to pay down debt. Long-term debt came down a lot, 700 million to 340 million. That's good, they're paying off their debt. Assets minus liabilities equals equity. 1 billion of equity. They raised 1.8 billion from selling their business. They lost 830 million from running their business. Let's look at the statement of cash flows. The first section is operating cash flow. And this is a pretty big milestone to have positive operating cash flow for the first time. The way you calculate operating cash flow, you start with your net loss of 133 million. Then you have to add back the non-cash items on the income statement. They have a lot of non-cash expenses. 50 million depreciation, 20 million of amortization. The big one is stock-based compensation, 136 million. Companies that are losing cash flow tend to pay more in stock-based compensation because they don't have as much cash to pay their employees in salary. So salary is subsidized with stock. In their investing section, they only spent 11 million in PP&E, so they have negative free cash flow because free cash flow is operating cash flow of 362,000 minus CapEx. 11 million. Let's look at the financing section. They paid down 310 million of debt. They paid 27 million of lease liabilities. So it looks like they're really trying to strengthen their balance sheet. Let's take a look at the company on Simply Wall Street. Its last price 14, 1.9 billion market cap, down 1% in the past week, down 6% in the past year. Let's see what they say about the company. FSLY operates an edge cloud platform for processing, serving, and securing its customers' applications in the US, APAC, Europe, and internationally. The Edge Cloud is a category of infrastructure as a service that enables developers to build, secure, and deliver digital experiences at the edge of the internet. The company offers network services to speed up and optimize the delivery of web and application traffic, device detection and geolocation, content delivery networks such as dynamic site acceleration, Origin Shield, Instant Purge, surrogate keys, programmatic control, content compression, reliability features, Fanout, Domainer, privacy, and modern protocols and performance services, as well as video streaming solutions and services, including live streaming, video on demand, and Media Shield. It also provides security solutions such as DDoS protection. DDoS stands for Distributed Denial of Services. Also, Next-Gen WAF. We talked about WAF earlier, Web Application Firewall, then bot management, API, and ATO protection. I'm sure you know what API stands for, Application programming interface. ATO is authorization to operate. They also mention advanced rate limiting and compliance services, load balancing, image optimization, transport layer security, platform TLS, and last, Origin Connect. It serves customers operating in digital publishing, media and entertainment, technology, online education, travel and hospitality, and financial services. They were formerly known as Sky Cash and changed its name to FSLY in May 2012. Incorporated in 2011, headquartered in San Francisco. They IPO'd in 2019 at $20. At the bottom of COVID, it was $11. It ran up to $126, so it 10x'd. Then it reached its all-time low at the end of 2022, a little over $8. So the stock has really struggled. It was up to $25 recently, then it came down to $14. They did beat earnings, but it wasn't as much as investors wanted it to be. As you can see, investor sentiment was high leading up to earnings, and they pushed the stock price to a pretty good number. They're expecting a blowout like a lot of companies this quarter, but they didn't deliver. FSLY did not deliver, so the stock came down. It looks like it could be a good time to buy. Simply Wall Street's price is 13. They say the stock is overvalued. 10 analysts priced this stock at 22. They say it's really undervalued. Here's their revenue targets for the next few years. $580 million in 2024, $670 million in 2025, $760 million in 2026. I assume these revenue targets in my model, and my stock price is pretty much where they're trading at. They were almost debt-free for a number of years. Then in 2021, they added $900 million of debt, but they've been paying that down little by little each year. It's down to $343 million. You can see their equity is always a little higher than their debt, which is good. And they have a lot of cash on their balance sheet, similar to the amount of debt they have. This green line is their cash, which it looks like tracks their debt. They don't list the CEO's salary, but total compensation is $22 million. Tenure as CEO is 1.5 years. It looks like the CEO recently sold $800,000 of stock. That's not what you want to see. And the co-founder notifies intention to sell stock. Last month, co-founder sold $1.5 million worth of stock. There is a fire sale by insiders. Lots of selling, no buying. One sell after another in the past year. Look how long this list is. This is easier to look at. So about 800,000 shares were sold by insiders in the past 12 months. None were purchased. 74% of companies held by institutions, 18% by the general public, and 8% by insiders. Vanguard is the biggest shareholder, and then Fidelity, BlackRock. The founder, Arthur Bergman, 5.7%. First Trust, Alliance Bernstein. Geode, the CEO, owns 1.2%. Two Sigma, Goldman, Schwab, BNY Mellon, Dry House Capital Management. Their employee count is going up. The only thing that's going up with this company, from 379 to 1,200. And the ticker trades on the Börse Stuttgart, the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.